Good morning, everyone. In today's lecture, we will try to discuss about the concept of annuity. As you are aware, in many financial transactions, either the entire sum of money is being paid in lump sum or we can have in the form of installment. Like I am talking about the hire purchase or installment system, that where we purchase the good and we make the payment in future months. Like you can say the concept of a recurring account which is being opened by a bank, that where we make the monthly deposit and after a certain period we are able to get the lump sum amount of the principal as well as the interest. Annuity basically means that either we are receiving or making the payment, a fixed amount of payment at a regular interval for a specific period, and we are trying to calculate that what will be the value of the future annuity as well as the present annuity. That means, like we can take the concept of insurance policy, that where we make the payment of the premium on monthly basis or half yearly basis or quarterly basis or yearly basis, and after the term of the plan is over, we are able to get the amount we have deposited with the insurance company along with the dividend. So here the concept is that how we are able to calculate the value in future, that what we are going to get if the monthly payment are being made or yearly payment are made for a specific term. Under annuity, we are trying to consider two concepts, annuity due and ordinary annuity. Annuity due means that when we make the payment at the beginning of the period, and ordinary annuity means when we make the payment or receive the payment at the end of the period. And in both the type of annuity, due and ordinary, we will take the concept of future value of annuity as well as the present value of annuity. That means we will take up first the ordinary annuity, and under this we will take up the future value of annuity and present value of annuity, and then we will take up annuity due. In that also we will take up the future value as well as the present value of annuity. The basic concept of annuity means that when any amount is being paid or received, a specific amount is being paid or received at regular interval for a specific term, then how we are supposed to calculate the value that is going to accumulate after a specific period at a specific rate of interest. This we can take up and discuss in today's lecture. So from the topic of time value of money, today we will try to take up the concept of annuity, that what we mean by annuity and how this annuity help us in calculating the future value as well as the present value. As you are aware that there are certain number of financial transactions where payments are made and received in lump sum. That means either the entire payment is made as a whole one time, or else the payment can be made or received in certain installments. That means I am trying to say, suppose we try to purchase any household appliances on hire purchase system or the installment basis. Then we purchase the goods, we make use of the goods, and the payment of the good is being made in certain installment for few months or years. The same method may be adopted by the companies also, where company try to purchase the huge plant and machinery or equipment, and the payments are made in future years itself in the form of months. Like we can say the bank also try to open certain schemes of deposits. We can say as recurring account, that where every month, the period that we have selected, we are supposed to make the deposit, and after a certain term, we are able to get the full amount of the deposit along with the interest. So basic, or like we can say also in terms of insurance premium also, that we purchase a policy and the premium of the policy is being made on every year or on monthly basis, quarterly basis, half-yearly basis, or yearly basis. And after the term of that policy, we get the maturity along with the dividend of that plan that we have purchased. So basically, here we are trying to talk about those investments where the concept of installment will be considered. Either the payment is being received or the payment is being made. Annuity is basically, we can say, a sequence of payment equal in amount at uniform time interval. Means what I am trying to say, that when we make a specific payment or we received any specific amount for a fixed period in the form of regular intervals. That means here the amount that we are making or the amount we are receiving is fixed for a specific term, and it will be received or paid on a regular interval basis. That means we are trying to say, like this line you can consider for better understanding, that a sequence of payment equal in amount made at uniform intervals. This can be considered as the concept of the annuity. That either we are making the payment or we are receiving the payment at regular interval, means the amount is fixed, the interval is fixed for a specific period. That concept can be called as the annuity, as the example that we have said while purchasing the household appliances, or the company purchase a huge plant, or the bank open a recurring account, or else we can say that we purchase an insurance policy itself. Now there are types of annuities also, what we can say. So types of annuities, as I said, that there will be 3 types of annuities based on payment terms, based on periodic payment, and based on payment date. Like the first we are saying as annuity certain. That means here the term of the annuity is certain. That means it is fixed for 4 years, 5 years. We can say that we have opened a plan that installment for payment toward purchase of a car is an example of annuity, certain as the payment term is fixed. Perpetual, where the payment term is not fixed. That means indefinite period, we can say, indefinite time. Indefinite time can be considered as that it is perpetual. And contingent, that is, we can say that this annuity is going to work where the happening of event is going to take place. Happening means, suppose we have purchased a life insurance policy, or the person has purchased a life insurance policy, and the policy is going to stop due to the happening, that is the death of the insured. That is a contingent annuity. Now, based on periodic payment, that means uniform, or else we can say the second is the variable, which can be in the increasing or decreasing. That where the amount remains equal. This is the basic concept about the annuity itself. That rupee 100 is there, then it will remain uniform 100 or 1000 throughout the period. Variable, where the amount of installment is going to increase or decrease as the term is going to increase or decrease. That means which every year either the installment is going to increase or either the installment is going to decrease. Like when we purchase a car, then the bank charges the principal amount and the interest amount. The club of principal and interest is the installment, and generally the bank charges the we can say as a decreasing form of interest. That means higher amount of interest in the initial period and lower amount of interest in the coming years itself or the coming months. So we can say that every month the installment amount is going to decrease. That we can say as the payment, periodic payment. Now, based on payment date, this is the most important aspect, and generally we will try to take up the numerical on this aspect also, that is payment date. Annuity due. That means when the annuity is payable at the beginning of the each period, like from the first of the month. That if we say we have taken a payment of rupees 1000 is made at the beginning of each year for 10 years, it is 10-year annuity due at the beginning. Annuity in arrear, that means when it is made at the end of each period. Now, the two important aspects are annuity due as well as ordinary annuity. Ordinary annuity is basically where the annuity is going to start immediately when the plan has been purchased. That is why it is known as ordinary annuity or immediate annuity. Basically, the concept of annuity in arrear will come in the ordinary itself. That means here you can say when the annuity begins immediately after purchasing the plan, where the periodic payments are made at the end of each period. That means annuity is going to start immediately when we have purchased the plan, but the periodic payments are going to be made at the end of each period. That is known as the ordinary annuity. And deferred annuity, which is going to take place after a specific term, begins from a deferred period, the period that we have selected. Like the example I have written, that we have purchased the annuity on 1st April 2011, but annuity is going to start from 31st March 2016. That can be said as the deferred annuity itself. Here, the most important aspect that we have to take up, that is the ordinary annuity and annuity due. These two concepts that we are supposed to take up in detail. The two types of annuities: ordinary, where the payment are going to made or received at the end of each period. Always try to remember, we will be discussing two types of annuities. At the end is the ordinary or immediate, and at the beginning will be the annuity due, as we have discussed here. That when the payment are made at the beginning of the period, it is annuity due, and when the payment are made at the end of the period, that will be ordinary or immediate annuity itself. Now the annuities we have to be discussed in two forms, because we are talking about the future value as well as the present value. So first of all, we take up the future value of annuity. Suppose that we are supposed to calculate the future value of annuity. Suppose X decide to deposit rupees 5,000 annually for 5 years at 10% per annum interest rate. What will be the maturity amount at the end of 5 years? That means what the person is doing, that the person is depositing 5,000 rupees annually. Every year 5,000 will be deposited, and the rate of interest is being given as 10%, and this deposit will be for 5 years. That means first year 5,000, second year 5,000, third year, fourth year, fifth year 5,000. That means we can say that for 5,000 will be deposited for 5,000. That means the actual amount will be 25,000. But this 25,000 will be deposited in a period of 5 years, and every year the interest will be given as 10% per annum. And we are supposed to calculate that what will be the amount the person is going to get in future after 5 years at the rate of 10%. Now, as you are aware, the ordinary annuity means that where the payment will be made at the end of the period. That means the first installment or first deposit will be done at the end of first year. That means this first year deposit will remain with the bank or any institution for a period of next 4 years, because first year is already ended. Second year will remain deposit with the institution for next 3 years. Third year for 2 years. Fourth year for 1 year. And 5th year, we can say the 5,000 will remain as 5,000. No interest will be generated because this amount of 5,000 will be deposited at the end of the 5th year. When the term or when the plan is going to mature. See how we have done this thing. The installment 5,000 at the end of 1st year, 5,000 2nd year, 5,000 3rd year, 4th year, and 5th year. Now, as you are aware, that 10% interest is given. So this amount of 5,000 will be deposited for 4 years. 2nd year, 3rd year, 4th year, and 5th year. So if we calculate this, that means 1.464 you will get at 7320. This amount for 3 years, 6655. This amount for 2 years, 6050. This amount for 1 year, 5500. And this amount will not generate any interest because we have received the deposit only at the end of the period. And total comes to as 30,525.5. This will be the future value of the annuity of rupees 5,000, which was invested every year for 5 years at a rate of interest of 10%. So actual amount was 25,000, but we have received the interest of 5,525.50 paisa if the interest rate is 10% itself. Right? I hope this is easy to understand. So we are able to receive 30,525.50 paisa as the future value of annuity. This was a small example where the term was only 5 years itself. That means on yearly basis. The calculation was only for 5 years. As you are also aware that here we get interest on interest. Interest should be compounding. Future value में हमेशा बढ़ता है और present value में हमेशा the value घटती है हमारी. तो future value में हमेशा हम लोग multiply करते हैं. See the rupee 1 plus R. R is the rate of interest. That is 10% itself. 1 plus 10. It will come to as 1.1 only. To the power n. N is the period for which it has been invested. It was 4. And this is the formula that we can derive for calculating any value for the future annuity. Future value of annuity itself. Here you can say R is the rate of interest. N is the period. 1 plus R power n is the same thing. Minus 1 upon R. That means if you are trying to find out the future value of any amount at a specific rate of interest, then you can make use of this equation. This is the installment amount. You can say as 5,000. This is 1. This is 10%. And this is for the 5 years. Minus 1. R is 10%. You will get the value as 30,525 here also with the help of this. Means here it was systematically shown that how the things are moving. And here with a single go, the single formula you are able to calculate. For this purpose also, a table of annuity has been constructed, which is called as future value annuity table, where you can look the value of 10% for 5 years. You look the value of 10% and 5 years, that value you multiply with 5,000, you will get the same reply. That is 30,525 itself. So either with the help of calculator, in this form you are able to do, or you can make use of the equation, the formula, or you can make use of the table itself and a single go you can calculate. This is the with the help of calculator, the formula base, and this is the table base itself. You can calculate the value of future value of annuity. The concept is very easy. Just you have to try to understand that what the concept says. In this context, you can take the small example also. Like you can read out that find the amount of ordinary annually of rupees 10,000 payable at the end of each year for 3 years at 9% per annum compounded annually. That it is a find the amount. Amount here means the future value itself. That we are supposed to find the future value. Annually 10,000 rupee has been invested for 3 years and the amount is known as, and the percentage is 9% compounded annually. Simple equation, periodic payment is R, that we say in the formula itself, R is 10,000. Rate of interest, small r, is known as 8%. And this interest is compounded annually, and that is for the period of 3 years. Simple formula that we make use, that is the equation that we have done here itself. And with that equation, you put the values and you are able to receive the answer itself. The interest amount you can easily calculate. That is what you have done. You have deposited rupees 10,000. You have deposited rupees 10,000 for 3 years, that makes 30,000. And you are getting as 32,000 something. That means this is the amount of interest that you are receiving. So this, it's very simple that you try to systematically you can do, but this can be possible only if the number of period is less. The 5 installments were there. Suppose the installments are 60, 70, 80 or 100 installments are there. Then this table formulation will be difficult for you. So for that purpose, you can refer the present value and annuity table because the standard values are given, or you can make use of your calculator and you can solve with the help of this equation also, right? So in this way, we have discussed today about the calculation of future value of annuity, the future value of annuity with concept to ordinary annuity itself, right? I hope it is clear to you. So we have just now taken with respect to future value. Now we take up the present value of annuity. As you are aware that the value of money changes with time itself. That means every year the value of money is going to depreciate. So the example that we have taken is just now with respect to future, where 5,000 was deposited, right, for 5 years itself. Same example I am trying to take up here. And you are also aware that when, because now the future value, the value will be discounted. Like see in this table, what is happening? This we will take up afterwards. 5,000, 5,000, 5,000, 5,000, 5,000. At the end we have received. So this will remain as the value of 5,000 in the first year will remain as 5,000. But second year value, it is going to depreciate at the rate of 10% only, the same example we have taken. And this is the discounting factor, discounting rate itself. Right? So first year 5,000 will be depreciated at the rate of 10%, it will be 4,545. Third year, it will be depreciated for 2 years because there are 2 more years, we can say. We have to bring the second year value itself. It will come to as 4132. Fourth year, 3756.50. And fifth year, it will be 34. That means rupee 1. The value of rupee 1 remain as 1 in the 0 year. This is the 0 year. In first year, the value of rupee 1 become as 9.909 if depreciated at the rate of 10%. It will become as 826 in second year, 0.751 in third year, and 0.683 in the fourth year. And this value has reduced to rupees 20,000. That means, although you have deposited rupees 5,000 for 5 years, that makes to 25,000. But at the end of the 5th year, the depreciated value of the present value of annuity is 20,848 only. Right? This is the equation which I was trying to say, that the value of rupee 1, that how to calculate the value of rupee 1 when it is going to depreciate at a specific rate of interest on for nth years itself, for n years itself. 1 upon 1 plus r plus power n. And this is the formula that we are able to derive. Again, I say that 5 installment was possible to show in a A4 size paper. But when this installment amount going to increase 10 to 20 to 40 to 60, then it will be a bit difficult for us for calculation. Then we can make use of the present value annuity table. Present value annuity table. Or else we can make use of the formula itself, we can say. This is the formula. R is the amount of the installment. This is the rate of interest. 1 minus bracket 1 plus R bracket close power 1n. In this way, we are able to calculate the value of present value of annuity itself. So for better understanding of this equation, we can take an example. Find the present value of annuity. The present value you have to calculate of rupees 10,000 payable at the end of each year for 10 years. If the money is worth is 4%, 4% is the rate of interest. And this is the value which has been provided to you. That means 1.04. This value, 1 plus R minus N. N is 10. R is 4% itself. So value of this portion has been given as 0.67556417. That means this R is 10,000, big R, small r is 4%, it is given as, and 1 minus this value. We are able to receive the present value of annuity after 10 years itself. That will come to as somewhere as 81,108 rupees. Right? So making the use of the formula itself, we have calculated the present value of annuity. Right? I hope this will make you understand about the future value of annuity as well as the present value of annuity with respect to ordinary or immediate annuity itself. In the next lecture, we will take up about annuity due. Right? Okay. Thank you all of you.